welcome everybody to the Insetting panel. My name is Haugen-Kozyra, and I'm the president of Viresco Solutions. I've been working in carbon accounting more than I would care to say how long that is, but working in the agricultural area, when the whole idea of insetting started to appear on the radar, it made a whole lot of sense for me to work with my clients on these kinds of programs. And I'm sure you're going to hear about this from the panelists in terms of how stakeholders view this process and what is the appeal of insetting. So we've got a panel here of people, a mix of standard-setting bodies, corporates who are actively doing Scope 3 programs, and also some project developers who have some interesting combinations of offsets and insets. So to my immediate left is Sally Flis from Nutrien Ag Solutions. Nutrien, she'll tell you all about what she's got going on in her company with respect to carbon markets and experimenting and pilots and programs. And then to the left of Sally is Thomas Blackburn from the Value Change Initiative, who just had their launch of the output from the third Ag Working Group. So I started working with Value Change back in 2018, and so watched them progress. It's getting really close. We're getting to see convergence with the standard fragmentation that's going on out there, and I think we'll talk a lot about that because I know there's a high level of frustration. And then to the left of Thomas Blackburn is John Alcock from Verra, and Verra is developing a Scope 3 program. John left my company, as well as Candace, his co-worker, to work on Scope 3 in Verra because of all the work we've done with Scope 3. And then on the far end is Max DuBuisson from Indigo Ag. So let's get started. We're going to start with maybe a little bit of an interactive thing to test everybody's knowledge or your exposure to insetting. So what's your definition of insetting? Is it door number one, buying carbon credits that are related to a corporate's sector, for example, food and ag? Is it buying carbon credits within a corporate's value chain? Or is it investing in emission reductions and removals within a corporate's inventory? So by show of hands, who thinks it's number one? How about number two? Okay, cool. And how about number three? Excellent. So and some people abstained. I do have an other. Other? You people have to be difficult. But I think just from the show of hands in the room, if you had turned around and looked, there's a lot of different impressions about what insetting is, and we're going to explore that in the panel today. There's many pseudonyms as well. So you will hear inset credits, insetting. I've got many of them on the bottom here. So depending on the organization or the program or the standards body, it isn't a standardized view right now. So we're going to walk through this and explore it. When I first heard about insetting, we worked with Monsanto, Legacy Monsanto, now Bayer Crop Science, and they were working on their decarbonization program and said, we want to do insetting, Karen, so help us with designing our insetting program. So it goes back to this paper, this thought piece in 2009, insetting and offsetting. In about the 2015 timeframe, there was a platform for insetting. It involved a lot of cosmetic companies, wine companies, chocolate companies, experimenting with developing insetting within their supply chains. And it's a going concern still. We've got a view of what that is within the land sector's removal guidance, and we'll talk a little bit about that. As I said, Verra is moving forward with a Scope 3 program. And John can talk to you more about that in terms of timing and expectations. The partnerships for climate smart commodities as well, right? That's carbon intensity embedded in commodities. And so we're not sure what that is, but all the applicants are moving forward with their various approaches to that. And then we have value change, which is probably the most furthest along, I would say, and a launch today that was pretty exciting, like I said, about that output for the Food and Ag Working Group, which Thomas will talk to us a little bit more about. The key challenge for a lot of the corporates who have set science-based targets, moving to net zero science-based targets, having to set a flag science-based target if you are in the forestry, land, and agriculture sector, is how do we interface intervention accounting with inventory reporting and to safeguard credible claims. So if anybody was on the launch this morning, Matt Ramlow from WRI, who's leading the land sector removals guidance, spoke about where they're at in that process. And this is not an easy undertaking. And it's absolutely essential if a corporate wants to be able to take actions for impact within their value chain and have it credible and claimable for reporting purposes for their science-based targets. One word around the situation that's going to be coming at us in the next month or two. So the Voluntary Carbon Market Integrity Initiative and the Science-Based Target Initiative are collaborating, although SBTI is starting a Scope 3 process. We can talk more about that. So they're moving forward with a Scope 3 standard, which, again, we're starting to see, but I'm confident we'll see convergence eventually with all of this effort. But the expectation for a corporate is that you're going to be taking within value chain actions and causing actions within your chain towards net zero that will, as time goes on, at your waypoints, will be counterbalancing your unabatable emissions with actions beyond your value chain. So call that an offset credit, call that some other way of compensating for the unabatable emissions as you're reporting along your journey to net zero. What that means is that we're going to have the actions that will be within the value chain and the flag science-based targets net out the removals in that, so your efforts are smaller for your unabatable emissions, which means you go into the beyond your value chain for less compensation, which is attractive. But the idea is you will be balancing until you finally get to net zero and then maintaining that with durable removals out in the future. So, as many corporates who didn't want to be in the offset game and wanted to focus on within value chain, they're going to be in both, is the reality. In the WRI draft guidance, there's the dreaded box 13.1, which caused so much consternation. What do they mean? We can't use inset credits towards our inventory and reporting? Holy crow. And this is WRI's reticence, sorry if anybody's in the room for WRI, to go down the pathway of market-based approaches in Scope 3. They allowed it in Scope 2 with renewable electricity certificates, and there wasn't a whole lot of green electrons on the grid. As a result, there was purchase certificates, efforts reducing Scope 2, and so they want to be very careful about how we deal with a market-based approach in Scope 3. And if you read the launch, or you can go on and get a recording of it on VCI's page, Thomas, yes? Okay. Correct. You can hear Matt Ramlow's response to the questions about, very direct questions, Renata, is she in the room? When are we going to have market-based mechanisms in Scope 3? Anyway, so there's reticence, and that's why inset credits, insetting, it's a term that maybe we want to move past. And then this morning, the launch of a very important piece of work that's 3 years in the making, the output of the Value Change Initiative Food and Agriculture Working Group. And so this piece of thinking and direction and tool set is likely going to be very compatible with where SBTI is thinking when they start their Scope 3 process. WRI is thinking it's going to, Matt didn't say this is it, but as they finish the survey on market-based mechanisms that some of you and many of you have replied to and provided input, he was giving favorable indications. And then finally, the million-dollar question, what counts towards SBTI and reporting? And if you go onto their FAQs, I don't know if you can read that, they talk a little bit about Scope 2 at the bottom, but they also say they're not sure about insetting. They'll be evaluating on a case-by-case basis through the validation process whether or not it will count. And that's why I think they're starting their own Scope 3 process that hopefully will be wrapped up, I'm hoping, towards Q3 of this year. So that's the landscape. Let's get into the panel. So we're going to give, the session will go 5 minutes or so for each panelist to talk about what they're doing in the space. And then we've got some questions that we're going to pose to the panelists. You don't have to, you can pass. You don't have to answer them all. And then we're going to open it to the floor. All right. Over to you, Sally.
Thanks, Karen. Sally Flis. I'm the Director of Sustainable Ag Programs and Outcome Generation. I don't know. I just had a title change, and I can't remember all the words every time. With Nutrien Ag Solutions. So Nutrien Ag Solutions is the largest ag retailer in the world. We have retail locations that work with growers in Australia, Latin America, and all of North America. So we work with growers to get practices, products, and programs out on the ground for crop production across those geographies. In our carbon and sustainable ag space, Karen's worked with us a lot, but we've spent 2 years trying to figure this out, which isn't a long amount of time compared to how long some of our other panel members have been working in this space. But we're getting very close on both some insets and some offsets across our programs. We're focusing mostly right now because the other half of our company is Nutrien, which is the largest manufacturer of nitrogen, phosphorus, and potassium fertilizers in the world, and the third largest manufacturer of nitrogen fertilizer in the world. So we're looking at how can we tie together the products that we're making with the programs that we're implementing in the field with growers. So focusing on that nitrogen use efficiency, the Climate Action Reserve's nitrogen management protocol, and how can we move growers along that continuous improvement for reducing nitrous oxide emissions. Not spending as much time in the removal space. We have some acres enrolled in new cover crops or new tillage practices, but really focusing on that easier transition to get growers in the door, to get data into our systems, and then as we figure out the other practices to implement around soil organic carbon and removals, adding those into the programs.
Thanks, Sally. Over to you, Thomas.
I'm Thomas Blackburn. I'm the head of business development for SustainCert. I have been with SustainCert for a number of years and been working with several of the people on this panel for over 4 years on this question of what is insetting. SustainCert is a verification and certification company. We were born out of the gold standard as their certification body. So we've been working pretty extensively on project level accounting as well as corporate accounting for a number of years. We have a mission overall to create effective market-based mechanisms in this space as well as digitize the verification process. So SustainCert is really focused on a digital-first approach, which means overall that we want to use technology to make the process more accurate, faster, and hopefully cheaper. It's the big one. Then we In 2019, we founded the Value Change Initiative with the Gold Standard, as well as a group from Science Based Targets and Danone and Mars. It was a really small group starting out with this question from a couple of companies that said, wow, we just set a huge science-based target and a huge amount of that is in our Scope 3. How are we actually going to achieve this Scope 3 target? Our efforts towards supplier engagement are slow, and we could spend the next decade sort of doing traceability exercises throughout our supply chain. So the value chain intervention guidance really came out of this question of, companies were launching programs to accelerate decarbonization in their supply chains. Is there a way that we could take those programs and actually get them accounted for towards a corporate inventory without having some of the needs of traceability and other challenges that arose out of that, so that companies could get a clear return on investment in the investments that they were making in their supply chain. So that's really where the guidance comes from. It has been iterated on now for the past 4 years in the Value Change Initiative. We have a group of over 40 companies that are involved from food and beverage and ag, and we just launched a second apparel working group that includes around 15, 16 companies from the apparel sector that are also looking at this. We have a lot of questions coming at us from transport around this as well, so sort of quickly expanding into additional areas. I think overall that guidance, we didn't take the perspective of how to make an offset work. We took the perspective of how could we align with inventory accounting with programs. And so it's a little bit different. There's some specifics in there, defining things like supply shed, using mass balance approach, et cetera, that make it slightly different from offsetting. It borrows from Scope 2 as well from the past in order to do that, and it adds a lot of safeguards into that process so that we can be sure that we're having strong impact and that those impacts are directly related to a corporate value chain, right? And I think we sort of threw out the word insetting with that. And we've been calling it value chain interventions, basically because we wanted to get more specific. Because there were so many definitions of insetting, we wanted to be very clear in the nomenclature. So, yeah. Jumped into insetting for 6 months, and then since then have been not talking about insetting.
Yes.
Yeah.
Yes. Thanks, Thomas. John.
Yeah, hi. Thanks for the invitation to sit on this panel. Thank you for the introduction, Karen. My name is John Alcock. I'm the Manager of Supply Chain Innovations at Verra. Verra, as probably most of you know, is a standard-setting organization with a mission to drive climate action and sustainable development. And so I was hired 12 months ago to look into how and whether Verra should develop a Scope 3 program. So we're, I guess, three years behind you guys at SustainCert, but so for the last 12 months, I've been operating the Scope 3 initiative. So this consisted of quite a lot of stakeholder engagement, really to figure out what companies are doing in terms of implementing the interventions within the Scope 3 inventory to reduce Scope 3 emissions. So what companies are doing, and then also figure out what the barriers and gaps are. And obviously that is with a view for Verra to develop a program to solve some of those gaps and barriers at the programmatic level. So what we've found, several things through the Scope 3 initiative. First of all, there's a whole range of things that companies are doing in terms of accounting and reporting their Scope 3 emissions. Some companies are using the methodologies from the VCS program to quantify interventions. Some companies are using the processes and infrastructure to get some kind of assurance of what they're doing within their Scope 3 emission reductions. And some companies are going all the way through to developing carbon credits, VCUs, and retiring those credits to demonstrate that there has been a reduction within their Scope 3 emissions inventory. So there's this whole range of ways that people are using the VCS program or parts of the VCS program. And so what we wanted to do is figure out, can we develop a program that is bespoke to these Scope 3 emissions claims and kind of address some of the issues that companies are finding with using the VCS program in that way. And so, yeah, we looked at solutions as well. We did some workshops on various different themes that I'm sure we're going to get into in the discussion, along the lines of how do we adapt methodologies, the VCS methodologies for this context, how do we deal with traceability and chain of custody issues, is there a space for market mechanisms in this context, how do we provide assurance. We also did one workshop on permanence. We were brave enough to go into how do we deal with removals and reversals in this space. So yeah, and I think really what we heard loud and clear through that was that companies really need assurance. There's nothing, or there's very little for companies to hang their hat on to say this has been an emission reduction within companies' Scope 3 emissions inventory. And they also companies want a way to transition their existing carbon credit projects towards a Scope 3 emissions claim. So now we're wrapping up that Scope 3 initiative and moving into program development. We got the go-ahead to develop a program just in the fall last year. And at a high level, that program, will aim to provide that assurance for companies of emission reductions occurring within their Scope 3 emissions inventory. It will try and leverage as much of the verified carbon standard infrastructure and methodologies, and some of the ongoing work in the verified carbon standard as well in terms of digitization of methodologies and the MRV processes. We'll also look to build a registry that will be GIS enabled and linked with the VCS registry, and provides options for projects to transition from carbon credit projects to Scope 3 projects. I got my work cut out for me over the next couple of years, but we're looking hopefully to launch in 2025. I know that's a long time frame, and it's not ideal for companies wanting to take action now. And so we want to develop this program really transparently and be open about the decisions that we're taking and what we're thinking. And so that will be a key theme over the next couple of years of trying to develop this program, being transparent and enabling companies to take action while we're developing the program. Building the plane as we fly it.
Yeah, John says he's got an ugly work plan.
I'll leave it there. Thanks.
Max.
Great. Well, thank you, Karen, for moderating this panel. Happy to be here with the rest of these panelists. Thanks to the Climate Action Reserve for having us at NACW. I think this is my 14th year at NACW. It's great to see it getting so big. Max DuBuisson, Vice President of Sustainability Policy and Engagement for Indigo Ag. I've been there about 3 years. Prior to that, I was at the Climate Action Reserve for quite a while. And Indigo is an ag tech startup. We're based in Boston, but we're a global company. We manufacture soil microbial amendments. We have a carbon program, and then we also have a digital grain contracting platform. So we have sort of physical and digital products. We got into the world of carbon in probably 2018. We started working with some of our biological growers on reducing their fertilizer application, and that morphed into launching our carbon program in 2019 with a very broad focus on the entire field, including the soil carbon. And we worked through 2020 in developing offset methodologies around this. But at the same time as we've been sort of building this big carbon project where we're developing, bringing growers together, we've got about 6 million acres enrolled in the project in the U.S., aggregating them, verifying them. We're selling these credits, and some of the companies that are buying these credits have agricultural supply chains, and they want to know, well, this is great, I can use these offsets, but I also need to reduce my emissions. And especially as they start to make these targets, net zero targets, where they have to reduce their emissions and not just use offsets. So we've been working on sort of sustainable sourcing, separate from the carbon project, for several years. We've been sourcing rice for AB InBev. I think a significant portion of American Budweiser now is indigo rice, if you drink Budweiser. We've been sourcing cotton for VF to go into their T-shirts, but these deals have been around the sustainable practices and not necessarily the impact. So we're not adjusting their inventory, but we are tracing the grain, we're tracing the fiber, and we're learning about how to connect the brands closer to the farmers and figure out their supply chains together. And so we started engaging in the VCI maybe 2 or 3 years ago, and that's been incredibly helpful for us. We've been engaging in the Verra process and understanding how do we take the system that we've built to generate offset credits, where we now have a software platform that we can collect data at the field level from growers about the management practices they're doing. We can incorporate the soil sampling data that we're taking. We can pass all that through validation and processing, applying any requirements from the protocols and any gap filling, and incorporating the remote sensing to validate what the grower is telling us through a model and into reporting. How do we then take that, instead of creating an offset, how do we create a supply chain reduction? And I think it's a really exciting time. So the funny thing I think about this panel is we told you all come here and let's talk about insetting, and then we're all sitting up here telling you there's no such thing as insetting. Because it's more than that, right? Like everybody means something different, and all the different definitions, I think, that Karen gave are valid actions. And maybe you call it insetting, maybe you don't. And it's a journey that a company can take. They can start with offsets, they can learn about their supply chain, they can get closer to their growers, and they can get to a point where now they do have the data that they need, and they have the traceability that they need, and you can account for it within their inventory. So for us, our focus is on the rigorous data collection and quantification, moving away from very broad averaged emission factors that are going to be crude. They're not going to reward growers in the way that they need to be rewarded for their good actions, actually tying it to performance, and getting to a point where this can all be done in a scalable way, it can all be verifiable and traceable and transparent. Thank you.
All right. So I've got a series of questions that I was going to run through our panelists, but this room is really, really overcrowded. I'm thinking we might get a lot of really cool questions from the floor. Like, I think people are probably just want to ask some questions of these people. So we can open the floor now. If there's a lull in the action, I can go back to the questions. Does that sit well with everybody? Moderator's prerogative. So who would like to ask a question? Yes.
Yeah.
And so let me just repeat it, because it's being recorded. So Arva Intelligence, forgive me for not remembering your name. Audrey, thank you. So she's asking Verra, but others can answer this if they wish. What does it take then, if you've got a VCU, right, to say, well, now I think I might want that to be an inset credit. Inset credit, damn it. Verified scope 3 mitigation outcome. John.
Thanks. Yeah, good question. There's a few things to this, as you might expect. So a VCU is a carbon credit, and it quantifies impact, so compared to a counterfactual baseline. And so that's what a VCU does, is it quantifies impact, and it is used as a single use, as a unique unit to offset an emission, an equivalent emission. The complexity comes when we talk about scope 3 emissions, is that we're looking at inventory accounting is what you use to quantify your greenhouse gas inventory. And so there's a complexity there trying to apply a credit to an inventory. So there are several issues you could think about. How do you deal with additionality? How do you deal with leakage? How do you deal with permanence in particular for removals? Those rules are all quite different in terms of how you use a carbon credit versus how you report that in a greenhouse gas inventory. But that's exactly the situation that the Scope 3 program is going to try and solve, is that how do we take what we've got, all that knowledge, all that expertise, all the know-how, the familiarity with the carbon credit market, how do we apply that to the Scope 3 context and create some way to move between those two markets as well, potentially. Tom, I don't know if you wanted to...
Yeah, I mean, I think you've covered most of them. I mean, the only things that I would add are, what's being checked in a project for a credit and a ton reduction isn't necessarily all of the data that you would need and want verified for it to be applied in your inventory. So you need information around how much good was impacted. You need information around where that program occurred, which is not that difficult. I mean, obviously that's in carbon offset projects as well. But in order to make those claims, there's some additional checks that sort of need to happen and linking it into inventory accounting. And I think I think those are the only things I would add.
Thomas, do you want to talk a little bit about supply shed sourcing region?
Yeah.
Okay.
So supply shed is a area of a sourcing region that a company can link back to and say that they source from a particular area. Typically what we're looking at is some sort of geographic plus what we call service equivalency in that supply shed. So if you're going to be making an intervention in your supply chain, you want to be sure that it's coming from an area that you're sourcing from, and you can show that somehow, and you also want it to be related to a grain or crop, in this instance of agricultural example, that is similar to the one that you actually use in your supply chain, right? So, if it's a different quality or something like that, then, there's more questions about the comparability of the emissions profiles of those various crops and qualities of grain, yeah.
And so if you don't have full traceability, the supply shed and the sourcing region, WRI calls it, and they're testing that in pilots that just closed, I think they're getting more comfortable with that, right? Not direct traceability. Max?
Yeah, just a couple of thoughts from the kind of practitioner perspective. We've been trying to unpack this as well. As we were engaging in VCI, we went through an exercise with one of our carbon buyers to dig into their grain procurement data and figure out actually how many of the credits that they were buying from us could be traced into their supply shed. And this was a very useful exercise, and we ended up with a number. We did have to dig into the actual yield coming off of those fields and the amount that they were procuring and figure that out. And then with the greenhouse gas protocol draft guidance, really trying to sort of tear intervention and inventory away from each other again and say, no, you do inventories. We've launched this approach called Field Flex, where essentially a field can be in a carbon project, and if in a year you're actually sourcing that grain and tracing it into the supply shed, we're doing an inventory on that grain. So you have that inventory accounting, and then you can go back into the intervention accounting, the credits that were issued, and cancel them, make sure that they don't get sold and used as offsets. And so in that way, you don't end up with overlapping claims, but you have continuous engagement with the farmer, continuous monitoring of the land, and you ensure that it doesn't just drop out somewhere and nobody's continuing to ensure the permanence and performance.
And perpetual monitoring of that property. Sally.
As defined in the greenhouse gas protocol.
As defined in the greenhouse gas protocol. That is still it's not finalized yet. Lots of feedback. Just a sec, Matthew. I think Sally just wants to...
We can go to a... Yeah.
Are you sure?
I don't have too much to add. We're doing very similar things, so we're taking an approach to growers that they don't necessarily need to understand if they're getting Scope 1 or Scope 3. The data is the same. When we want to analyze across all of our sustainability metrics, we're collecting every event that happens in that field from the date that field is planted till the date that field is harvested. And so we can then figure out what the best fit is for either our partners or for our own inventories to take that credit to the next step.
Thanks. Matthew.
Yeah, Matthew Wallington, Agri Australia. Just like some comment on who bears the risk of reversal and say during supply chain management in terms of like any removal, so like this sort of harsh weather, risk of reversal sits. And then there's a second follow-up question also too, just some comments on
So question from Matthew Agriprove from Australia, one of the largest aggregators there on soil organic carbon. Question number 1, who bears the risk for the reversal? Question number 2, you were almost getting into business model stuff, right? A little bit? Yeah? Who gets paid? How? Right. Okay. Great questions, Matthew. All right. Sally?
The risk of the reversals on removals is one of the reasons we're focusing on emission reductions only, because those can't be reversed, right? We can only get to the end of the crop season and find out that for whatever management reason, the grower didn't have the reduction, and so we don't include that field and the grower doesn't get paid. But we really have not done a lot with removals because we haven't felt that there's a big enough value to us to have to be responsible for removals occurring. So we're not there comfortable with that as a risk point as a business. We're paying the growers. We pay the growers directly. It is a credit on their account with us at this point in time, and that's largely just because we are not set up really well to pay growers cash. But they're credited to their account that they have at their branch location. At this point in time, they're credited the whole value of the credit that they generate. We did pay for practice in our 2021 projects, and now we do pay for outcome. So based on their expected emission reduction, whether or not they're using the nitrification inhibitor, we do a minimum payment of $1.50 just because we have some growers in very dry regions of the country where nitrification inhibitors don't work, and where there isn't a high rate of application. So even with a 30% rate reduction, you're not going to generate a huge emission reduction value. So we do a minimum payment of $1.50 for the grower to implement at least that 5% rate reduction emission. It's not a huge payment. Just doing emission reductions is probably the biggest pushback we get in the field. But we've seen in the growers we're working with that it opens up more opportunities because the growers that want to participate the most right now within our organization already are doing the soil organic carbon practices. So there isn't an opportunity there for them on soil organic carbon in the first place because there isn't another practice to do. But they can always look at refining their nitrogen management program and adding other enhanced efficiency products to continue to improve that nitrogen use efficiency.
Thomas, do you want to take that on?
The business model question?
Yeah, business model.
Okay. Yeah, so the cool part about Scope 3 is that there's a lot of double counting that happens as products move through the economy, right? And each company is accounting for the emissions of the embedded emissions of products that they purchase, mostly through purchased goods and services in Category 1 of Scope 3. So that's a huge portion of overall global emissions, actually, that plus use of sold products. And what's interesting about that is that, when one person creates a reduction in the supply chain, it means that it impacts everybody else in that supply chain that sit downstream from them, right? And even upstream in the case of use of sold products. So what's very interesting about a Scope 3 reduction is that you could create an alliance within supply chains to actually do co-investment into projects and all get to claim the reductions out of those. So it's a different story than a unique claim coming out of an offset. And it goes towards, the reduction of towards your science-based target, if this is approved, right?
A couple benefits there, and more back to the grower. We'll just finish up, and then I'll come to you, Adam. John, anything to say?
Just from more of a kind of markets perspective as well, I think, linking the Scope 3 claims market, if you want to call it that, and an offset market could drive, competition between those two markets. And so if a company is really motivated to reduce its Scope 3 emissions and wants to claim that, then they can pay for that claim. Alternatively, if the owner of that intervention wants to generate carbon credits because the carbon credit market is looking more financially viable or suitable, then creating that flexibility I think is important.
Which it definitely is now, right? Yeah.
Right,
yeah.
right. And how that works out with the nested inventories, as Thomas was saying, would be very interesting to see actually, because a Scope 3 claim, like Thomas said, would potentially benefit multiple companies through a supply chain.
And Max, oh, sorry.
No, go ahead.
Go ahead. Okay, Max, you're in the game, right? You're attempting this, so a little more color?
Yeah, I mean, we focus mainly on soil carbon, so we think a lot about the permanence part of it. We think that, the draft greenhouse gas protocol guidance, putting that liability on the brand to keep monitoring a field forever. I mean, show of hands, how many of your companies are committing to things forever that have a liability? Nobody's doing that. So we see a role for the practitioners to be that middle layer. We take on the liability in the offset project for those growers. We would take on the liability in the same way, and especially if that field, like I said, is enrolled in an offset project. We've already got structure there that can manage that. We do need more structure for these other fields, people that are already doing it but are, getting into supply chain programs. And then in terms of, the business model, on the carbon, they get paid per ton, so our growers get 75% of whatever revenue is generated for credits sold on their field. And if they're in a sourcing program, they get a premium per unit output. And so those premiums depend, they're not quite as standardized as the carbon price.
Great. Adam?
I'm Adam Young, the Electric Power Research Institute. I've been around this space for a long time, and I hope you're all confused designers. So I have a question, because Sally raised a great point. The difference between paying for practice or paying for performance. These SKUs are performance-based. You achieve a climate impact, reduce emissions, make removals are actually measured. They're a climate outcome versus a practice that may or may not achieve a climate outcome. And I've heard Insetting described as sort of like offsets. They would be outcome-based. But I've heard it more often described as sort of practices. And so I really want to understand is, when you guys talk about Insetting, are we talking about real, verifiable, quantifiable emission reductions in the supply chain? Or are we talking about writing a check to change some practices that may or may not have an actual climate?
Who wants to take that on?
Yeah, I mean, I can take it on. Yes, we're talking about real verifiable outcomes, right? That's the aim of all of the programs. There is the question, though, of how the farmer relationship is set up for that, to achieve that, right? So that could be that a company or someone who's running an intervention, whether it's a project developer, et cetera, wants to use a mechanism to pay farmers for practice change and then see what those outcomes are in order for them to then monetize those things or to use them in their inventory, right? So it's outcomes based. Yeah. It is very similar, I mean, in some ways, right? However, it's just much more directly linked to a company's actual supply chain, and the way that you're doing the quantification needs to link back into the inventory accounting or the emission factor or LCA work that they're doing, right? So it's a bit of a design change in terms of how we do it and the rules that are put on it. So you could think of it as a much more sort of specific or nuanced carbon offset, right? But there's a lot of criteria that you have to meet in order to be able to claim it.
So there isn't additionality per se, where you and I grew up in the space, Adam. It's causality. If anybody wants to take on causality, and then I'll get to you, Connor. Causality.
I can take on causality. So causality here is because we are trying to get towards a outcome with companies and their inventories. Additionality isn't as important. Like there, you're saying we are essentially trading in the guidance causality for the lack of traceability in this instance, right? So we want to be sure that the company is actually making an investment in order to be able to show some sort of claim, and we want to be able to verify that that was a reduction that occurred that is, as close to their supply chain as they can get the information. So that's those are the sort of criteria that are around it, and causality is making sure that the practice is new, right? I mean that the company helped cause that. It's just not an additionality threshold to say, yes, it needs to be new. Does it need to be a
Not
financial
BAU?
analysis?
Not BAU?
Is a different story. Yeah.
Anybody else want to tackle that one? Nope. Okay, Connor.
Has there been any clarity from NACW protocol on
So in the Sustain Cert program, there's no banking. It has to flow through the value chain that year. Anybody else have thoughts on that? Because
For reductions, right? I mean, removals, the guidance is
still the jury's still out, but the WRI got a ton of feedback on the pilots, and nobody's happy with this perpetual monitoring situation, because if a farm drops out of your intervention or inventory, it's considered removal. And so it's almost like locking in your suppliers, and not many CPG companies can do that. So we'll see what happens with the responses, and then I think a lot of people in this room had put in a lot of feedback to WRI on market-based mechanisms on Scope 1, 2, 3. So I wish we could say that it's finished, but it's not. And then SPTI is starting their Scope 3 discussions as well. But we think that the VCI output that was announced this morning, go read it, I think it'll fit, but we'll see.
right. And I mean, what's there now, and that question of risk that was asked earlier, I mean, that's on, I think right now it's on the company for that perpetual monitoring of, just so that's, yeah.
John, do you want to talk about Verra's monitoring proposal? Do you know much about it?
For DMLV?
Well, the long-term monitoring and the proposal you guys, Candace spoke to it at COP, that Verra has a proposal out, they're getting feedback on building a long-term monitoring system. So, for example, in VM42, your liability period for a VCU in a project is 30 years. And then the rest of the 100 years on the last ton sequestered, Verra will take on, with the buffer reserves that have, been built up by the residual buffer reserves. So the proposal is to build a long-term remote sensing monitoring system for properties that are involved in offset projects. And Candace had said there's no reason why that couldn't be used for this process.
Yeah, it could translate into a Scope 3 accounting for removals as well. But there's some fundamental differences, right, in terms of the way Greenhouse Gas Protocol considers removals and only considering carbon dioxide. So time horizons are perpetual because you don't need global warming potential because you're only considering carbon dioxide. So I think there's a whole bunch of, we could get into that. But yeah, I think in principle, it could also apply. Yeah.
Okay, another question for oh yes, go ahead.
Appreciate the speaker's perspectives. All of the discussion so far has been about agricultural supply chain. Wondering about insets and other industries. My company specifies billions of dollars a year of construction materials. What if we look at changes in the concrete industry? Energy company that wants to deal with upstream oil and gas emissions, leakage from exploration. Do you see movement in things besides ag?
Thomas?
Yeah, sure. Yeah, I mean, we see a lot. There's a lot of initiatives around, sustainable aviation fuel. There's a lot of initiatives around transport in particular that are popping up right now. We have moved into the apparel sector because we saw a lot of demand similar to ag, but it's sort of this, long, complex supply chains and changing suppliers that make it very difficult for companies to make long-term investments that, yield results and return towards their targets, right? And so we very much, the approach that we created, hopefully is applicable in multiple sectors and across categories of Scope 3. So, because it is linking into the way that GHG protocol does inventory accounting, it should be an approach that's applicable across multiple areas, and sectors.
John?
Yeah, I just add ag has probably been the leading sector on figuring out how Scope 3 works and how we can account for it and that kind of thing. My background is in ag as well, so there's a bias that I'm putting on the table. But through the Scope 3 initiative, it was clear to me actually and surprising that a lot of the other sectors that we were working with, parallel and actually construction and technology, a few other sectors, all are facing quite similar issues to ag. I think it's a misnomer in a lot of cases that ag has these issues and it's only ag. I think it's a lot of other sectors have very similar issues in terms of traceability, supply chain volatility, and then how do you work with those supply chain realities in this context of inventory accounting? So
I'd add, I think a lot of it is the drivers, is the science-based target. So like Sally and the World Business Council, Nutrien and others, Yara, have been asking for a pathway, science-based pathway for fertilizers. And so they've been told that we're going to do chemicals all together. So that's starting. We understand soon. There is no oil and gas pathway in SBTI. So, you know, that traditional driver that causes demand for these things doesn't exist in some sectors yet. So that isn't, as John said, it's not stopping people because the blueprint is an existing protocol methodology that you can adapt into your supply chain. So there's nothing holding you back from that if you wanted to get started. Cars starting on a cement methodology. ACR is doing a BEX. They're starting a BEX one. John, you've got a variety of methodologies across many sectors. So in biochar, I think the first one out was Verra. Car's working on theirs. There's all sorts of things that you could start with. How are we doing for time? We have 8 more minutes. Wait, Peter. Peter first, then I'll call on you.
Oh, thank you. Hi, I'm Peter Weisberg at 3 Degrees. We've centered WRI, I think rightfully so, but I think our sense is there's likely to be a long period of uncertainty where it's unclear whether or not they're going to allow market-based accounting, how they'll do it. And so my question is, what do we do in the interim? Like, do you see your standards as a solution right now with use cases, or is this really about getting standards that will then work with WRI and we just have to wait and advocate?
Yeah, I think I can take that one. Yeah, I think at Verra we're focused on what our stakeholders want, and so they want assurance that their emission reductions are occurring and all the rest of that goes with that. I think, you know, we'd love to align with WRI and SBTI as much as possible, but what we heard interestingly through our stakeholder initiative was a lot of companies saying if the accounting rules don't change, then we might look elsewhere outside of WRI and SBTI, which is we don't want that to happen. And so I think the approach that we want to take is, okay, how can we build something and demonstrate that it works, that it's credible, and work with WRI and SBTI and the rest of those folks on demonstrating that it can work with the right safeguards.
Yeah, I think it's both. I think it's easier for standards to look at something and see that it's working and got good safeguards for them to, you know, approve it and say, yeah, let's go that direction, right? So I think it's a bit of both, and people do want to get cracking, right? I mean, we are running out of time, as the IPCC said just this week, right? So we've got to get action on the ground as soon as possible.
I do think also that, your guidance, Thomas, that you have out there, and I think your verification 0.9, I'm not sure if it's available on your website, but it's a good thing to get started on. So VCI has your guidance from 2021.
Correct.
And you have your 0.9 version verification guidance, and there's different levels of verification that you can think about in there. What are we seeing, Thomas, in terms of finalization of some of that stuff, or a version 1 of the verification and a next update to the guidance?
Yeah, so we're hoping to have an update to the guidance later this year, incorporating a lot of what we just put out with the Food and Ag Working Group output. We were considering waiting for feedback from the apparel group, but I think we'll come out with a version before then. And then we also will come out with an updated version of the rules and requirements for the verification process that we are offering right now, which is, testing this guidance and the approach that we've taken in the value change initiative. So that should come before, in the next quarter, it should come before the middle of the year in terms of those requirements. And then we've built a system that allows for these things to be publicly displayed. So it's a little bit of a registry there, and then allowing for the actual impacts to be transferred between layers of a supply chain. So as we were saying, that co-investment that needs to happen, and allowing for that information to actually flow through a supply chain linked to LCA frameworks. So it's super exciting, actually, that's going to be live and running, and we'll probably see a few people actually using it in the next couple of months. So, yeah.
Cool. And then, Sally, I'm going to turn it over to you because Nutrien didn't hold back. You got 9 things going on across the landscape in North America. You want to speak to a little bit about that?
Yeah, at least 9, Karen. So to go back to the question about other industries, right? So something that gets very complicated for us when we look at our Scope 3 accounting is we're both the manufacturer and the distributor of the fertilizer, but we don't use only our nitrogen fertilizer. We buy nitrogen fertilizer from everybody else who makes nitrogen fertilizer because of logistic needs. There's somebody else who's closer, and so it saves us money to buy from the manufacturer that's there instead of our own. So and we don't even have the traceability within our own system for a sales shed to figure out where is a pound of fertilizer that's produced at this plant ending up and what field does that go into. So just trying to coordinate within our own company to figure out what our Category 11 and Category 1 is around the fertilizer use, not to mention the other 14 categories that we have to account for around moving the fertilizer, employees involved with the fertilizer, gets to be very complicated. The connections don't always exist there. And then we know there's practices and product use in the field. So I think to address the previous question on what do we do right now, even though the guidance isn't clear, is we can't do anything without the grower data. So we can't go from, we know we sold X number of tons of fertilizer that are slow controlled release or are treated with a nitrification inhibitor product and just say that means we reduce our Scope 3, right? We have to know where that's going. And without that grower field level data of practices implemented and products used, either within our own systems or in a grower data management system, we can't make any of those claims to look at our own Scope 3 footprint. So we're trying, like Karen said, we're trying a little bit of everything and just trying to figure out how to get that grower data so we have the information in order to make the claims and understand what our footprint really is.
Yeah, and the other question about what should we be doing, supplier engagement, right? Start talking to your suppliers about what they're doing, what kind of commitments have they made, because that's going to be really important as you're starting to think about value chain, and read the guidance, get some ideas about what you want to do. I think what we're going to see in the next 9 months to the end of 2024 is all of you will be involved in carbon accounting discussions, more than you ever wanted to be, because it's all going to be focused on this carbon accounting according to the different standards that are out there. And I'm really hoping, and I know VCI is working hard to see convergence with SBTI, with WRI, with VCI. So we're going to be in a little bit of a time of uncertainty, Peter, but that doesn't mean you can't not get going. Right? Alicia. Good last question.
Can I just make a quick, and no, we work very closely with Thomas on trying to figure this out, but it isn't. Scope 3 is no easier than Scope 1. It is the same amount of data, it is the same information, it is additional accounting, and then you add in this layer of, we have to do all the same things we have to do for Scope 1 to get to what is our emission reduction and the number of tons that we're impacting based on the yield that came off those fields, and we have to know where it came from. So we have to know if it's in the supply shed of the Category 1 person that might actually want to use that. So Scope 3 is not easier. Thomas might have a different opinion, but in my experience, in trying to get through both Scope 1 and Scope 3, there is no difference. It's the same thing. It's the same
Sally,
data. It's
come
the same
on.
work. And we might have some partners.
But we believe it will scale better than doing a project, right? That's the hope. And we've heard today about the streamlining that people want to do or standard bodies wants to do so it's more efficient and we get more action on the landscape. Yeah. Any last words, guys?
Yeah, I think it's not about Scope 3 being easier. I think it's about we need to make all of it easier. Offsets
Exactly.
and Scope 3 and going digital, scaling it larger, without losing any of that transparency, verifiability, repeatability. We can do all of that now. We've got better technologies, and it'll work differently in different sectors and different project types. But I'm excited about the efforts you guys are making at your organizations for this, and we're trying to put it into practice.
Line up partnerships. This thing's all about partnerships. With that, please join me in thanking our panel. It's very informative.